Oil and gas investing is one of the most powerful ways to reduce your taxes in America. Literally 65 to 85% of your investment into a qualified company can be deducted as a loss on your tax return in the first year of your investment. But in addition to that, what makes oil and gas investing even more attractive is that you can use those losses to offset your W-2 income, business income, or other forms of income that you earn. Almost no other investment allows you to do this because most investment income is treated as passive income. And if you have a loss on paper, that loss can only be used to offset other passive income on your tax return. However, qualified oil and gas investments are not considered passive and can therefore be used to offset earned income on your tax return. The only other investments that you can use to accomplish similar results are investments into a business, which everyone may not have an opportunity to do, or rental property investments, which requires you to jump through a lot of red tape and meet very specific criteria in order to use those losses against your ordinary income. But oil and gas investing simply involves you moving money to a qualified company, and upon doing so, your losses can be used to offset your W-2 or business income on your tax return. Plus, it's an investment, right? Which means that you also have the ability to preserve your capital and increase your wealth through such an investment. So as a licensed CPA that tax plans around things like this every day at mycpacoach.com, I want to walk you through how you can use oil and gas investments specifically to reduce your own taxes. So let's take a step back and look at why this tax benefit exists in the first place. Specifically, we want to know why the government allows such large tax benefits for oil and gas companies. And it's actually quite simple. Our society relies on oil and gas to function every single day. We use it to fuel our cars, heat our homes, cook our food, transport goods, and even in consumer products like detergents, beauty products, and so on. But then there's also the cost of oil and gas, which can be volatile. A simple rise in oil prices could literally trigger an economic downturn. So to prevent this, the government simply wants to increase the supply of oil and gas, and there's already an abundant amount of resources and reserves in the US. The government just needs to tap into it to increase production. And that's where the tax law comes into play here. The government is not going to do this themselves. So instead of conducting their own drilling operations to increase oil production, they just use the tax law to incentivize other people or private companies to do this on their own, which in turn benefits society at large. Now, with that being said, let's talk about the specific tax benefits of investing in oil and gas. So to encourage oil and gas investing, investors receive the following benefits. Number one, the cost of drilling, exploration, and production associated with the oil and gas wells are tax deductible because these costs are massive and investors are directly liable for them. And secondly, investors have a working interest in the oil and gas investments. Now, this feature is what turns the investment from a passive investment into an active investment that can offset your ordinary W-2 or business income. But it gets even better here. There are additional tax deductions like number three, the intangible drilling cost deduction. Now, this allows companies to write off so much more of their materials, labor, and other services, which typically amounts to 65 to 85% of your investment, which is what allows 65 to 85% of your investment to be tax deductible in the first year. And to make it even better, you can also take advantage of number four, depreciation, which allows you to write off the cost of tangible assets like equipment and machinery. Now, for context here, depreciation alone is what allows real estate investors to deduct such large amounts of their properties every single year. But when it comes to oil and gas, this is just one additional benefit when you invest in a qualified company. Now, with all of that said, if you were interested in investing in oil and gas, how exactly would you go about doing this? Okay, so first of all, this is not a stock that you can buy on a public exchange. So if you go out there and buy oil and gas stocks thinking that you're going to receive these tax benefits, then you will be in for a surprise. You would need to specifically invest in a private oil and gas company that conducts drilling operations. Just do a quick Google search and you will quickly find several companies that accept these types of investments. Now, of course, with any investment company or any investment in general, you will want to carefully evaluate the risk. And to be completely fair, your investment in an oil and gas company is not guaranteed to be successful. For one, there is the risk that the company you invest in does not manage your investment as promised. Or two, there is the risk that your investment performs poorly. Some people lose their entire investment when investing in these companies, which is why it is very important for you to do your own research if you are going at this alone without a CPA or financial advisor. Now, because of the risk involved, the SEC typically limits these types of investments to accredited investors. Now, these are usually individuals that meet certain income or net worth requirements to navigate the risk involved with these sorts of investments. And to qualify as an accredited investor, you must meet one of the following criteria. Either one, you have earned at least $200,000 in each of the last 2 years, or $300,000 if you are married. Or two, you have a net worth of $1 million or more. Or number three, you have certain credentials recognized by FINRA, such as having a Series 7, Series 65, or 82 license. But if you meet either one of these, then you would qualify to make accredited investments into oil and gas companies, allowing you to take full advantage of the tax benefits available. But again, be sure to do your research, talk to your CPA or financial advisor about the risk involved, and consider all other available options to reduce your taxes if that is your primary objective. If you want immediate tax advice to reduce your next tax bill, just apply to work with one of my CPAs today at mycpacoach.com. Thank you for watching.